So I'm Christina Papanikolopoulou. I'm a lawyer with Zepos and Yannopoulos. We're a Greek law firm based in Athens. We're going to be talking about Greek debt today. I have with me a very distinguished panel, Mr. Antonios Kerastaris, who's the Group CEO for Intralot, Vasilios Kotsiras, who's the Head of Funding Solution and Structure Finance at National Bank of Greece, Guy Morgan, who's the Managing Director, EMEA Head of Liability Management at Goldman Sachs, Mr. Philip Brown, Managing Director, Public Sector Fixed Income Origination at Citi, and last but not least, Henrik Johnsson, who's the Managing Director and co-head of Global Syndicate and Debt Capital Markets for Deutsche Bank. Unfortunately, Giulio Baratta of EMEA will not be able to join us because the weather is bad in London, as we all know. So, Greek debt. 2017 was a very good year, both for the sovereign debt. We had the first bond issue since 2014, and then we had banks and corporates bond issuances of approximately 3 billion. So we're here to discuss why was this year so successful and what are the prospects for the future. And if I may, I'll turn to, and we'll start with the issuer side. And Mr. Kerastaris, if I can start with you. In September, Intralot issued a 500 million euro bond, which was oversubscribed 3 times. So what contributed to this success and this, what are the prospects for next issuances? Also, some other Greek corporates opted for the domestic market. Why do you think that happened, and why did Intralot continue with international markets?
Good morning, everybody. Thanks for having us. 2017 was indeed a very good year for the markets. The yields were down. I think that our execution in September was successful not just because it was oversubscribed 3 times, but because of the size and mainly of the duration. Now, a 7-year bond for a Greek issuer is a new thing. So it was not just the size or the coupon, but I think it's also the duration that gives a very clear signal that something in the market is changing about how they see Greek assets. Now, is Intralot a Greek asset? Not really, but it's Greek-based. So, you know, we've been having all the downside of being considered a Greek issuer, although our business is 97% outside of our home country. Now, in terms of whether you go to the markets outside Greece or the Greek bond market, for us it was a very clear decision. There were a number of Greek issuers that were relatively successful in the Greek market, but I think that the overall size of the Greek market is small for a bond of $500 million. So even if you do manage to issue the first time, I think it's going to be a challenge to refinance products like that, and that is why we clearly took a stand to go to the Euro markets and the international markets for our bonds. So I think that looking forward, yields are going to be better for Greek issuers. I think the market has come to understand our business, and the market has come to understand that the risks associated with Greek issuers are less today than they were a couple of years back. And I think that if the markets continue to be strong, 2008 may even be a better year for Greek issuers than 17.
Okay, thank you. And Vasilios, turning to you, covered bonds. NBG issued covered bonds this year, along with the rest of the systemic banks. Again, oversubscribed, quite successful. What does that signal for a Greek bank debt?
Thanks, Christina. First of all, by default, to discuss in this panel about Greek banks' bonds, it is definitely a sign of progress of the Greek financing sector. We should not forget that it was only 2 years ago that the Greek banks proceeded to a liability management exercise which led to an debt-to-equity swap for the share capital increases of 2015. Back then, we set up a strategy that it would lead the bank again to the establishment of the debt capital market. We decided to opt for the Irish example, as we call it, that it was followed by the Irish banks in 2012, where they first started with managing their collaterals, engaging to interbanking repo transactions, and then gradually proceeding to secure debt transactions. In 2016, we concluded the first Greek SME securitization, which was placed to IFIs, and we named it Synepia. Synepia means, it's not easy to translate it in English, but it is actually reliability and consistency. And this is the virtues that the Greek banks should share. As for the debt investors, these are the principles in order to trust you again. So, coming in 2017 and managing to reaccess the markets with the covered bond transaction, it was proved that there is a significant demand for international investors for Greek secured debt. They have met all their objectives by expanding our investor base, not only to UK or US investors, but also to other regions of Europe, like Germany and Italy. The cost efficiency compared to other debt instruments, the ELA disengagement efforts, and of course, what was very important for us, the solid secondary market performance. But how to move forward, it is not as easy, and definitely nothing has really changed to where we were standing till 1 year ago. Exiting the ELA will bring the Greek banks in front of other challenges, and those challenges will be LCR, NSFR, MREL requirements, and all these they need again to be strategically planned, because exiting from probably the covered bond transaction was only the last action of the ones designed to exit ELA by the end of 2017, beginning of 2018, but it was only the first one to establish our position to the debt capital markets.
Right, okay. Thank you very much, Vasily. Henrik, from the investor's perspective, both corporate issuers, Greek corporate issuers and Greek banks, how do you think they are perceived, and how do they compare with other European issuers, non-core European issuers like Italian ones?
Sure, thank you. And maybe I should start with, even though with a name like Henrik, it's not obvious that I have a Greek connection, but I was actually born in Athens.
I didn't know that. Okay.
I always enjoy when I have a chance to interact with Greek issuers and people in general. So I think to answer your question, it's great to hear the issuer perspective on this panel, because I think everyone is pretty much focused on doing the right thing. From an investor perspective, there's a relatively simple equation, which is that primary supply begets demand. So when you see issuers, starting with the sovereign and then very highly rated corporates with a lot of assets outside of Greece accessing the market, and those transactions being very successful from a primary perspective, that in turn generates more interest. And I think the sort of the trajectory that Greece is on now is actually very similar to some of the things that we saw from Ireland earlier, Portugal or Italy, in the sense that first you get the higher rated issuers or the, I guess, fundamentally very strong issuers that go out and test the market and end up paying a premium to finance relative to their peers in other countries. But then as those deals settle, investors move on to the next one, and then they have a relative value argument when they talk to the decision makers within their firms. And I think having the confluence of both the sovereign creating a curve, which is obviously happening simultaneously, as well as the banks, through secured issuance, covered bonds, and highly rated corporates, it just creates this ecosystem that becomes very investable. So I would say from generically across the investor sort of universe, obviously they're doing their work. They look at each credit on a fundamental basis in isolation, but I think all of Greece is very investable, and it's really just about getting that price and timing right, which is very different from a year ago when things felt extremely challenging. So I think there's been huge movement, and I wouldn't be surprised if there's more sort of capital inflows into people looking to invest in Greece.
Right. So we've moved from whether to invest or not to just a pricing issue.
Yes.
Okay, that's very positive. And if we go to this offer now, Guy, you worked on the recent exchange of the PSI bond. What will this signify for the international investors and for how these bonds will perform in the future?
Yeah, sure.
The Greek bonds.
We had the honor to, I guess, execute the recent PSI exchange for the Hellenic Republic. I think that was a cornerstone in regards to the Hellenic coming back on a more regular, frequent basis to the market. I think maybe before we talk about the PSI and what that means, I think the precursor to that was obviously the new 5-year deal done in the summer. Mm-hmm. That was a critical element to, I guess, bringing the sovereign back on a more frequent basis, because that showed to the market, or showed the market, that they have access. The transaction was very well subscribed. But what it did as well is it started to, at least in the front end of the PSI curve, the normalization. And that's really what, I guess, the PDMA has always set out, to ultimately normalize the yield curve such that it can come back more frequently and more flexibly in regards to tenors. I guess the obvious next step from that 5-year deal, which certainly pulled in the front end of the PSI, was to address the PSI curve in itself. As you all know, that's obviously a legacy from 2012. It has it had very limited liquidity. It was difficult to trade, and therefore you saw as well a, call it, abnormal yield curve for a, call it, more frequent issuer, meaning that it was very flat throughout the curve. There were jumps in specific maturities, but also it was inverted, which obviously is something that is, I guess, a reflection of the illiquidity of that instrument. So the goal that the PDMA set out was to tackle that legacy curve, to basically set markets for a more frequent access. So by consolidating these PSIs into 5 benchmarks, not only have they set themselves up for a more liquid curve, a more efficient curve, that also is an important reference for future issuances. And future issuances which opens up to maybe longer tenors. Up until now it's been 3s and 5s. Now with, I guess, the curve as it is, and as you probably all know, has performed very well since the closure of the exchange. That certainly then sets it up for different maturities. I think with it as well, with this transaction, and already actually in the lead up to the transaction, there was obviously a lot of noise around this potential transaction. We certainly seen as well a rotation of investors, and I think that was as well an important point from the PDMA perspective to rotate out, call it the more event-driven investors into what we call the more sticky and often for an issuer reliable investor base, call it the asset managers. And we saw that in the run-up to the trade. So there was certainly a lot of trading of event-driven accounts, trading out, taking profits, and more real money asset managers coming in. That has continued. And that, I think, again, is a sign that the transaction has achieved its objectives and also has set the PDMA up for future issuances.
Right.
Maybe just to add to what Guy said, we like Guy have been fortunate enough to see a lot of Greek transactions now over the last 2 years, and the investor rotation point is really extraordinary. When you go through the books on deals done 2 years ago and the most recent deals, frankly, 2 years ago it was mainly distressed type investors who were the top allocations, and then went by hedge funds, roughly a year ago, and most recently it's pretty much all real money. So that normalization is very strong.
Right. Philip, what do you think in terms of investors, types of investors, and how would the Greek sovereign debt compare to other European sovereigns?
So I'd really like to echo the comments of my colleagues, really. I think the backdrop to the success of the 2 transactions we've seen for Greek government bonds in 2017, both of which we were happy to have been involved with, is, I think, the backdrop to coming to an end of QE. We're coming to, interest rates have been at extremely, bottom cycle levels within Europe, and we will probably see rates rise from here. If we look at the performance of Euro government bond indices, both last year and this year, Greece has actually been the outperformer. I think last year we saw core markets return about 3%. Greece returned just over 7%. This year we've seen most core markets, with the exception of France, who saw a strong recovery after the election result. But we saw the other core markets return something like 1%. And Greece has returned a spectacular 17% this year, which for American investors, if we also consider that the euro has appreciated by some 13% versus the dollar, is a truly spectacular performance, I think, judged against any asset class. And I think the investors take confidence of the lessons of the other ESM, EFSF program countries. The recovery of Ireland has been quite spectacular, but is now really quite a long way behind us, as Ireland is now well established among soft core countries in Europe. And I think in Portugal, we have also seen fairly spectacular performance from a small market. Portuguese bonds have also returned double-digit returns this year. And I think as we look forward to 2018, when rates are forecast to rise more sharply, we will probably see negative returns from core markets. But again, I think there's room for further spread compression of Greece versus Germany. And, I think we haven't yet seen the core European asset managers and pension funds embrace peripheral markets. We still haven't really seen that in countries like Spain and Italy. I think, I'm always reminded of the view of the Spanish Treasury, which is that, real money is as real money does. And I think the hedge fund community has done extremely well out of the recovery in Greek government bond markets. And I think they've been extremely loyal to the Greek government bond market really since the crisis. They are the guys who have been there and done the heavy lifting. But the exchange that Guy talked about was really spectacular, just in terms of showing us the diversification of the holdings of Greek government bonds. We had 17,000 instructions from investors into that exchange out of the 20 PSI bonds into the 5 new benchmarks. I think 13,000 of those instructions came from investors who held less than $100,000 of debt. And it was remarkable to see how many of those instructions came from custodians in France and Germany So it is very interesting, I think, that you know, the populations of France and Germany have a lot of confidence in the further recovery of Greece, and they've done very well by their investments there. But I think for the market to move forward, we would like to see, as we get out of the program, we'd like to see restrictions on Greek investors to hold Greek bonds lifted a little bit. I think that would be helpful. But we continue to see the transition that Guy and Henrik have spoken about as real money, long-term investors start to re-engage. But you know, I think the investor composition of Greek government bonds is really not so very dissimilar to what we've seen in Spain and in Portugal a couple of years ago, and I think we'll continue, as my colleagues have said, to see that, you know, to see Greek debt be more widely held among a broad array of European institutional investors.
Right. Yes. And Mr. Kerastaris, in this climate and positive results so far, what do you think are the key factors for Intralot or other corporate issuers for the next year? Is it building investor relations? Is it the jurisdictional risk and how that is now perceived? A combination of those?
I think it's a combination of all. So you have issuers there that are doing very well. You have fund managers that have made significant profits from the Greek bonds or the Greek company bonds. This is always helpful because it builds on previous success. You've got the issuers coming back to the markets with a story that has been tested, and this builds the confidence. And I think that both the sovereign bonds as well as corporate bonds are seeing a change in the portfolio of the investors. So you go from the hedge funds of this world to the BlackRocks and the Fidelities of this world, which is always a very positive signal. So it means that confidence is coming back for the issuers. You have to be there consistently. You have to spend the time with your IR and your debt people. You have to do your presentations. You have to deliver the story. You have to deliver the results against the story. And it's a build-up. So, you know, 3-4 years ago, the story was completely different. Greece was, I think, significantly different than it is today. We're not out of the rough sea yet, but there is clear progress. And I think that the corporates that are consistently out there issuing and delivering against promises and results are going to see a better future in the years to come.
Right, so it's synepia again and again, consistency. And Vasili, as you said, there are regulatory requirements that will need new issuances of from the Greek banks. Again, what does this mean for the banks? Is it a question of funding cost? Is it tapping the markets?
Exactly. It is a much more complex environment of objectives that you have to meet when you will be eventually exiting ELA and becoming a normal European bank. There you will have to meet the LCR ratios, the NSFR ratios, the MREL ratios. All this means a higher cost compared to the one that we are experiencing even from the ELA or the other short-term funding platforms. Nevertheless, what has been achieved through the GGB curve and this massive tightening is an encouraging step of what is going to be eventually the actual cost. The second part is, again, to what we have said, to how you communicate to the investors your progress. And progress means 4 pillars, as we have said them from the beginning when we started talking with credit investors, which was the divestment plan of the bank, the disengagement of the Eurosystem funding, the NPE management, and the domestic operational profitability. As this will be improving, we will have also clarity on terms of what's going to be the IFRS 9 impact, and the stress test of 2018 results, that I'm convinced that we will meet a much better environment to issue even unsecured and subordinated debt. But definitely these are bullets that we use them from our arsenal at a period where still the income of the banks hasn't really started increasing at the rhythms we are expecting. So we should be very conservative and very prudent to how we are proceeding to that.
And the four pillars you mentioned, is that four pillars without any categorization, or would the NPE management, which has been discussed so much and with such intensity, be more important than others? Or how?
No, I think that the Greek banks definitely will have a lot of personnel. So definitely we can manage to run parallel strategies and meeting our targets. And all these ones, let's say the one assists the other and especially the investors to understand where they're standing and what is the credit. So if you are improving your profitability, that means that you have higher income. If you are managing your NPE issue, that means that your asset quality is improving. So bail-inable instruments are not that much in stress at the analysis. The investment plans also are providing you cheaper cost of funding, although you're losing some income. So it is a whole four-pillar strategy that you follow it in parallel. Sometimes you're going better at the one or the other, but at the end, the result is what it counts.
And to our bankers, we discussed in the panels before that Greece is about to exit the third economic adjustment program in the summer, and whether that will be a clean exit or something else. How again do you think that this will impact investors' appetite for sovereign and corporate bank debt in general?
Let me maybe start. Yeah, obviously 2018 is a very important year for the Republic, and I'm sure there'll be a lot of discussions around that. I think just kind of diverting back to the PSI transaction and the part, I think, that strategic move or the moves in the capital markets and the timing around that is actually, or potentially, an important part around, come August of 2018. Clearly, by doing these transactions this year, I think it has set up the Republic for certainly coming back to the market next year. There's no kind of delay on that front. So I think timing around these transactions is important. Now, clearly the Republic is going through their reforms. There's all kinds of things, they still need to accomplish. But at least from a market standpoint, the key question is obviously going to be, how are they going to fund themselves going forward? Obviously, of the aid they have received, they still have unused capacity. That will certainly, help that. But I think demonstrating to the market, again, back to the point of being more frequent to the market, that the market is actually helping them to potentially exit on a clean basis. I think that could be an important factor when it comes to the decision around that. Obviously, there's still a lot of things that need to be done, but I think that's a contribution from the market perspective, that it can show or can demonstrate that the investors are behind them, that they can provide the funding. So I think that's going to be key going forward as soon as next quarter.
I think that's actually a great summary of the sovereign story. And I think I'd just add that from an investor point of view, you've had a situation now where essentially it was risky but easy to invest in Greek debt across all the credit spectrum, because there was a correlation of everything together, basically. And if Greece followed the same pattern as the other peripheral European countries, then everything would trade up, as we've heard the spectacular performance. I think now it goes down into the details. And I think I liked what you said, Antonios, about delivering delivery and consistency, because I think that goes for the sovereign as well. Clearly, you know, the exit is not going to be painless, and there's a lot of details that needs to be worked out. And I think the main thing that investors will be looking for from all Greek entities is communication and now delivery of the details. So, you know, it goes into, you know, how exactly is the exit going to happen? You know, are the reforms carried through? You know, do companies now grow their cash flow and allow people to invest? You know, those are the harder things to invest in. But I think the preconditions are there, and now it's down to the individual issuer to make sure that they, you know, access the capital markets consistently.
Yeah, I think investors can take comfort that the third review has been completed very quickly. So there is no great extended public disagreement, really, between the Troika and the Greek authorities. I think you know, the fact that the consensus that there is within Europe now that Greece is ready for a clean exit, I think is very comforting. I think there are some critical things to come in 2018. We've got the long discussed debt forgiveness. You know, this is something that the new German government is going to have to address, and that will be very interesting. But I think investors also recognize that, yeah, the private sector has done a lot in terms of contributing towards debt sustainability, and now perhaps it's the turn of the official sector. But I think private sector investors in the government bonds take great comfort from knowing that, you know, of the 180% debt to GDP, only 30% is with the private sector. So, you know, people perceive that significantly reduces the risk to private sector investors going forward. I think people also think in terms of debt sustainability as, you know, is it a debt to GDP calculation or a debt service cost to GDP calculation? And, you know, we're having so much of its external debt is lending from the official sector. You know, Greece is borrowing with a AA financing rate. And I think we heard from ESM this morning that the short-term measures have been completed. So I think ESM has done a lot to reduce Greece's interest rate risk exposure going forward. So I think investors generally feel that the mood within Europe is now transitioning with the change of government in Germany, the change of government in France. We're moving towards a focus on austerity and risk reduction, maybe to a focus of risk sharing a little bit more. I think it's very interesting that Jeroen Dijsselbloem, as the leader of the president of the Eurogroup of finance ministers, has been replaced by Mario Centeno, the socialist finance minister of Portugal. You know, I think this is very good, sending a signal of support from core Europe towards the periphery. And I think there is a consensus across Europe now that you know, people want to see Greece remain within the single market. So there has to be further room for spread compression. I think when we started to talk about the PSI consolidation trade, 10-year Greece was trading 500 over Germany. I think 10-year Greece today is about 415 over Germany. And I think Greece could easily tighten 100 basis points more readily than any other country within Europe. So I think the other point to mention that Declan Costello mentioned this morning was that the preparation has been very well done. Greece has got an extremely limited borrowing requirement going forward from a sovereign perspective. It's extremely manageable, and I'm sure we're going to see their transactions oversubscribed.
Maybe just to add to that, I guess when we look at it on a relative value, I guess the other country to mention is obviously Portugal. They're 10 years at, I think, like just over 1.5%. So there's still, I guess from that perspective, people like to draw parallels with Portugal. There is still a lot of upside. Obviously, there'll be road bumps or speed bumps, as we always have. But just maybe one anecdotal evidence that currently I think investors have quite a bit of confidence in the Republic, and that is when we did the PSI exchange, we exchanged the PSIs that are covered by the co-financing agreement back from the restructuring in 2012. The new securities are outside of that. Clearly investors, when you do these kind of transactions, focus on it. Was it a big concern from the international community? No. So I think that's another kind of anecdotal evidence that they do not see this kind of all unraveling and it was just one big bubble and will end up into the dark days around the Greek debt. So I think that's just another piece of evidence of where international bondholders stand in regards to Greece.
Great, thank you. So all of these are very positive messages for Greek debt. Do we have any questions from the audience? Nothing? Okay. In that case, thank you very much. We have one. I'm sorry. Oh, sorry.
I'm Robert Tipp with PGIM. Just one question about the restructuring for anybody. Unlike the recent 5-year issue that was both 144A and Reg S, so that both U.S. investors and foreign investors could participate, although there are a significant amount of U.S. investors that have supported Greece in the PSI bonds, they were not, my understanding, they were not eligible to participate in the swap. So they are, those issuers are kind of marooned in the PSI bonds, only a tiny fraction of which are left outstanding. It's a significant amount, but a small fraction. And the trading in those is quite impaired. So I'm curious if anyone has any idea why that was or what the future of those bonds may be.
Guy, maybe?
Yeah, sure. Look, I guess the fact that U.S. investors were excluded from or onshore, just to be clear, onshore investors were excluded is because, as you rightly say, there was not a 144A tranche. The reason why that was so is really from, it's very specific tax, legal, or security law related. Without kind of, going into the detail, it was related to when the original PSIs were issued that they were coming at a big original issue discount, which has tax implications. Obviously, it's unfortunate that they could not be included. I think, from the syndicate perspective and the PDMA perspective, there was a lot of effort to try and solve for that issue. Clearly, obviously, the 86% plus take-up evidence, despite having to exclude the US investors, it was a great success. In regards to, what happens to these, I guess, investors that still, US onshore investors that still hold the PSIs, there's obviously, given the performance of the new deal or the new tranches, I guess there's maybe always an opportunity of selling them in the secondary market and picking them up, given they've seasoned already now.
Thank you.
Yeah, we just echo that it was clearly very unfortunate that onshore US could not participate, but that was the result of clear and extensive tax advice. But the performance that we spoke about in the GGB curve leading up to the debt swap and since then has hopefully benefited everybody. I don't know, we shall see what happens in 2018, but the documentation for the exchange did not preclude something happening in the future to help those guys. So anyway, let's wait and see. But in the meantime, it's clearly been very good for everybody that this transaction brought so much international focus and optimism to the GGB curve overall, as Guy has said.
Great. Anyone else? Right, so this concludes the panel and this discussion. Thank you very much, everyone. Thank you, gentlemen.
Thank you.